Foreign investors just pulled more than $20 billion out of Indian stocks in 4 months. That's more money than left the entire country during any full year on record, and it happened before most people even noticed the trend had started. If you own Indian equities or have money in funds tracking the Nifty or Sensex, this matters more than the headlines suggest. India's market isn't just correcting, it's revealing a structural problem that 3 separate forces are now exposing at the same time. And when you connect them, the picture gets uncomfortable fast. Start with the obvious trigger. War broke out in Iran, and oil prices spiked. India imports 90% of its energy, most of it from the Middle East. When crude surges, India doesn't just pay more, it becomes one of the most vulnerable major economies on the planet, because higher energy costs hit everything from airlines to fertilizer to the trade deficit. Foreign fund managers did the math. If oil stays elevated, India's growth story gets expensive in a hurry. So they sold. But the timing reveals something deeper. They weren't just reacting to oil. They were already looking for an exit, because India's stock market had become the most expensive in the world. The price-to-earnings ratio hit 23, well above historical norms and higher than any major peer. 80% of listed companies were trading in what analysts quietly called the overvalued zone. It wasn't speculation, it was math. Stocks had run so far ahead of earnings that even optimistic forecasts couldn't justify the prices. Then the third piece landed, and it's the one that makes a reversal feel less like a possibility and more like an inevitability. Corporate earnings growth has slowed sharply. For 9 consecutive quarters, company revenues have trailed India's overall economic growth. Nominal GDP expansion, the number that matters most for corporate profits, hit a 6-year low. Real growth looks fine on paper, above 7%, but nominal growth, which includes inflation and directly feeds into sales and margins, has stalled. When companies can't grow revenue faster than the economy, and the economy is slowing in nominal terms, there's no fundamental support for elevated stock prices. The market has already started to reprice. The Nifty dropped 14% from its peak by mid-March. That's the textbook definition of a correction, but the forces driving it haven't reversed. Oil remains volatile because the Iran conflict isn't resolved. Valuations are still stretched even after the decline. And earnings forecasts keep getting trimmed as analysts absorb the reality of slower nominal growth. What makes this different from past corrections is that retail investors, the group that poured a record $72 billion into Indian stocks last year, are now feeling the pain in a way they haven't before. Small cap and mid cap stocks, where most retail money went, have been hit harder than the headline indices suggest. Losses in derivatives trading alone have cost Indian retail investors $40 billion over the past 4 years. These are professional traders. They're people who believe the hype, bought at the top, and are now watching their portfolios shrink while foreign institutions quietly exit at scale. History says corrections driven by external shocks typically recover in 6 to 12 months, assuming the shock fades. But this isn't just an external shock. It's a valuation reset colliding with an earnings slowdown while energy prices remain a wild card. All 3 would need to reverse for the market to regain momentum, and right now, none of them are moving in the right direction. The question isn't whether India's market will eventually recover, it probably will. The question is whether the people holding stocks today will still be holding them when it does, or whether they'll sell into the next wave of optimism, scarred by the lesson that what goes up without earnings to match always, eventually, comes back down.